Korea's banks have quietly replaced credit risk management with a simpler product: 100% government guarantees on messenger app loans. Three things happening in Korea's financial sector today. Every major Korean bank is now racing to become a crypto custody provider. Woori Bank is cutting 20 overseas branches, unwinding a decade of international expansion as part of a broader restructuring. And the Public Guarantee Fund backing those loans just hit a number that regulators are watching closely. It's Tuesday, August 25th. Let's break down what's happening in Korea's financial sector. Korean banks are shifting credit risk off their balance sheets and onto public guarantee funds, competing on messaging app approval speed rather than borrower assessment. Simultaneously, all five major banks are positioning to enter the crypto custody business ahead of anticipated regulatory clearance, treating it as the next fee-based trust service. And Woori Bank's overseas network reduction signals a broader retrenchment from the international expansion strategies Korean banks built through the 2010s. Here's what the numbers show. Korea's public loan guarantee funds recorded default payouts of 3.55 trillion won, $2.6 billion in full year 2024, with the first half of 2026 alone already reaching 4 trillion won, $2.9 billion. The half-year figure already surpassing the prior full-year total. Individual borrowers can access guarantees of up to 135 to 140 million won per person, approximately 97,000 to 101,000 US dollars, with loans approved through messaging applications without direct bank credit assessment. Financial supervisors have flagged that the model transfers credit risk from bank balance sheets to public funds, a systemic concentration that parallels structural patterns seen ahead of prior credit cycles in Korea. KB, Shinhan, Hana, Woori, and IBK are all pursuing crypto custody licenses, positioning the business as functionally analogous to existing trust services under Korean financial law. Woori Bank cut 20 overseas branches as part of a restructuring that reduced its total overseas network significantly in the first half of 2026. XRP surged approximately 50% over 1 week, a reminder of the digital asset volatility that Korean banks are now seeking to enter through custody services. So what does this mean for those watching Korea's financial sector? Earlier, we said Korean banks are replacing credit risk assessment with 100% government guarantees. Here's what that actually means for you. When banks stop pricing credit risk and governments absorb it, the guarantee fund default payout becomes the systemic pressure gauge. And H1 2026 at 4 trillion won, already exceeding full year 2024, is the number that should be on every regulator's desk. The simultaneous push into crypto custody shows Korean banks are hunting fee-based revenue, even as their core lending model is under structural stress from two directions: margin compression and accumulating contingent liabilities. These trends define the risk profile of Korean banking through 2027. Watch the Financial Services Commission's review of guarantee fund exposure limits. Any tightening would directly constrain bank lending growth and force a credit screening rethink. Watch the timeline for crypto custody license approvals, which will determine how quickly banks can diversify their fee income base. And watch whether other major Korean banks follow Woori's overseas network retrenchment in H2 2026. That's today's AI PRISM. Finance Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a WAN-IFRA award-winning series. We'll be back tomorrow.